You're welcome to Campus Easyland Media. So we are once again we are going to now be looking at another topic, which is partnership accounts that how we maintain accounts for partnership businesses. So obviously, you are going to see that some of the accounts you are supposed to prepare, they are supposed to be prepared in the income statement, which are written here. The income statement. Then we shall see how they prepare the profit and loss appropriation account. Then we shall go to we are going to look at how they maintain their capital accounts, or financial accounts. Then we are going to end with a statement of financial position. Statement of financial position. So basically, those are the accounts we are going to be looking at under partnerships. So I'm going to, of course, the income statement. We are going to see that most of us know we prepare the income statement. So we shall start. We may not look at how they prepare it because that one is generally rich to know how they prepare the income statement. But we are going to start from, because it is the figure of net profit we get with the income statement, from which we prepare the appropriation account. So we are going to be going through the appropriation account. Then we shall look at how partners maintain their capital accounts. Then the statement of financial position. Those are the final accounts basically we look at. The accounts we prepare basically in partnership businesses. So we are going to start right away. So like I was saying, the final accounts must be income statement, appropriation account, then the capital accounts, and we end with the financial position. So I'm going to start with the income statement. Income statement we prepare it in the normal way, but we are going to start under partnership business. We are interested in that net profit figure you get from the income statement. That last figure that you get from the income statement, which is our net profit. So on that net profit, the net profit figure you get from the income statement, you are supposed to start to prepare an appropriation account. So we are going to do from our net profit, we prepare an appropriation account. So when you are starting to prepare this account, you start with the net profit figure you get from your income statement. So which is that figure is what I bring here. And now I'm supposed to make adjustments on that figure. Basically, we are going to see that we adjust a few things. For instance, on that figure of the net profit I get from the income, I'm supposed to be adding interest on the drawings. Because remember, this profit is for the partnership business. Now the partners drew you may find that some partners drew money from the business. So they are supposed to pay the business. They are supposed to pay to give us some money because of drawing money from the business, which is the interest on drawings. We charge them interest on drawing. So it increases our profits. That's why we are adding it to the what? To the net profit figure, because it increases our profit. It is the partners to give the partnership, to pay the partnership back. Then we are supposed to be raising interest on capital. You are going to see that if partners contribute capital, you start a business, the partner contributes capital, you can give him the partnership business can decide to give him back for contributing capital. In other words, you are giving them back for contributing capital. It means you'll be giving them that, maybe I can call it a commission, or you'll be giving them that that kind of appreciation, and you'll be paying it out of the profits. So it means the partnership will be losing money, and you are giving it to the partners, interest on capital. Partners contribute, and now you are paying them. So it will be paid out of the profits. That's why we are showing that we are raising it. Because it produces our profits, you are supposed to pay it out of the profits. Then partner salaries, if any. In our case, for instance, I only recognize that it is partner A who is subject to salary. The partnership can specify that a given partner is supposed to receive salary. So in this case, of course, even the salary, it is the business now is paying partner's salary. It is now paid out of the profits. That's why we are still raising it. Then, after making these adjustments, adding interest on drawings, then interest on capital, raising partner's salaries, you'll be getting a given figure which you are calling profit to be shared. And that profit to be shared, we are supposed to share it according to the ratios that were given in the question. The ratios, the ways in which they are supposed to share the profit. But in case they aren't given, you share the losses. That ratio is not given. You're supposed to be sharing the losses, the profits or losses equally. So I think that is all the appropriation account, as long as you know the adjustments, that net profit figure which you get from income statement. Then you add on interest on drawings, because this is the partnership business. It is the partners now paying the business. We raise interest on capital because it is the partners to pay that interest. It is the partnership to pay the partners that capital. Then partner salary it is the partnership to cater for that expense. Then we shall get our profits to share among the partners. So that is all with the appropriation account. Then we are going to see how they maintain their capital accounts. We shall see the application of this in an example. So there are two methods of maintaining capital accounts of partners. One, we have the fixed balance method. And under that method, we are going to see that under the fixed balance method, we open up two accounts. One, we are going to call it the capital account. Then the other will be the current account. So the capital account, it will look in this format. Depending on the number of partners you're having, you'll be having those number of columns in relation to the number of partners. So for us, we have taken an example of having two partners, that is partner A and partner B. So it means when you're opening up the capital account, now we are first looking at this fixed balance method. You'll be opening up one account, which is the capital account. I mean two accounts, capital account and current account. The capital account is going to be recording only opening balances of capital and additional capital, if any. Some instances they don't give additional capital, so you just maintain that one of what you just record the opening balance of capital account, and then it will be the closing balance. So it is fixed in that way. This one is like our fixed account. Now the current account under this fixed balance method is supposed to record the dealings between the partnership business and the partners. Things like if partners draw money, the drawings will be there. If partners are paying some interest on drawings, interest on capital, such things. So you're going to see that for under this method of the fixed balance, here we basically record the opening balance. In the capital account, take note that it only records the opening balance of capital and the additional capital if it is there. Then for the current account, it is going to record the dealings, like we said. So it's going to start, they will give you the two balances. For the capital, they will give you the opening balance for capital account for both partners A and B, so you'll be recording it there. They also give you the opening balance for the current account for both partners A and B. So they brought, of course, you'll be recognizing it, the opening balance is there in the capital account. Then all these other contents you are seeing in the current account, you are going to see that we get them from the appropriation account. But you need to investigate their effect on the capital. Is the capital increasing or reducing? For instance, of course, capital has to increases by crediting. It has a normal credit balance. That's why the opening balance is this type. Then you look at interest on capital. If partners are receiving interest on capital, are their accounts increasing or reducing? Of course, if you are receiving interest for capital, you contributed, your accounts must be increasing. So you recognize that their capital is increasing, so you increase it on the capital account of the partners. So interest on capital must be credited because capital increases by crediting. Then you go to partners' salaries. If partners are receiving salaries, of course, the accounts must be increasing. That's why you still recognize capital increasing by crediting it. Then, still the share of profits to that stage in the appropriation account, we must also recognize it here. When they are sharing profits, their accounts are increasing, so we debit it, we credit it. Then when you got things like drawings, it is the only component that we don't find in the appropriation account, but you must also bring it there, bring it in the current account. Then interest on drawings, of course, if you are paying for drawing money from the business, your account must be reducing, your capital must be reducing. So we debit that, and capital reduces by debiting. Then share of losses, of course, if you have to share a loss, you are contributing towards that loss. So it means your capital must be reducing. So we debit that capital reducing. At the end of the day, you are going to have closing, of course, you are going to balance off the columns, and you'll be having the closing balances, which you will be taking to the balance sheet of the partnership business. Even this side, the closing balances must be specified in the balance sheet of the business. So we've seen the fixed balance, now we are looking at the fluctuating. Fluctuating, when you are maintaining capital accounts, and the question makes mention that it is the capital accounts of partners are maintained using the fluctuating balance method. So here we open up one account, which is the capital account, which records everything that relates to the partnership. Like we are recording the other side, here you are going to record everything in one account, which is called the capital account. It is fluctuating, so the balances keep on changing. So you're going to see that maybe the other thing that we did not record here, additional capital. Additional capital must be recorded because it increases on the capital of partners, additional capital of a given partner. Then the closing balance. So fluctuating is basically similar to the other one, but here you open up one account that records everything. But under fixed, we open up the capital and current, which records capital only records opening balances and additional capital, if any. Then the current is supposed to record current dealing between the partnership and partners. But fluctuating, one account records everything relating to the partnership business. But in some questions, they don't mention that the business is maintaining fluctuating or fixed. It is upon you to see how many accounts are they including. For instance, a question can come, then they mention capital account, they give you a balance, a figure for both partners. Then the current account, they give you a figure for both partners. So it is upon you to know that they are talking about the fixed balance method, because it is where you open up two accounts. Then, if a question comes and they are only making mention, they are only giving you the balances of capital account, there you should immediately make an assumption that they are operating a fluctuating method. They are operating their accounts or maintaining their capital accounts using the fluctuating method. So we are finished basically how they maintain the accounts. Now we are going to be looking at goodwill. So according to what we have just seen, now we are going to have this number to work it out, whereby we are going to look at preparation of the income statement. Then we get that net profit figure, from which we are going to prepare an appropriation account. Then after preparing that appropriation account, we shall say we are going to post the entries of the appropriation account from the appropriation accounts to the capital accounts of partners, because at the end of the day we are going to see that the question is reflecting I think the last part is this one, the end part, which is showing that you are required to prepare the partner Bwambale and Masereka's income statement, then prepare partners' current accounts, then prepare the balance sheet of the partners. So from that number I've just shared, you are going to see that we are going to, of course I'm not going to prepare the income statement because that one everyone knows how to prepare it, but we are interested in getting the net profit figure from the income statement, which when you calculate you have to come up with this figure, and from that figure in the question, of course they were requiring us to prepare the when you check, you are requiring us to prepare the Bwambale and Masereka's income statement. Of course, this is the income statement I've prepared. This is the figure I've got from my income statement because it's where you get the profit, net profit. So now, part B was requesting you to prepare the partner's current account. So obviously, contents of the current accounts must be from the appropriation account. So it means I must start with the appropriation account. Appropriation account of partners. And we said in the operational account we start with the net profit figure. Net profit, which is in this case 46740. Then so they told us that we are supposed to prepare the current accounts of the partners. So it means, remember in the question you saw that we have the capital for both partners, opening balances of capital, and also we have the opening balances of the current account. It means you just know from that illustration that we are operating a fixed balance method, but they have just requested for only one account, capital account. So it means the current account. The current account records the dealings. In other words, you have to first prepare the appropriation account from which you get the contents to take to the capital accounts of partners. To the capital accounts of partners, the current account. So we start from the net profit figure, which when you calculate the income statement, you'll be coming up with this figure. Then interest on drawings was specified in the question if you check additional information. They gave interest on the interest on drawings for both partners as being 360 and 240 respectively. So we said we add it there in our operational account, add interest on drawings. I've added to this figure, we're supposed to add this. Then you less interest on capital. We saw why we less interest on capital, and they said it should be 10% on the capital contributed. So you can't look out for the capital balances for both partners relating to the capital account. So if you check the capital balance for Bwambale in the capital account, it is 70,000, and for Masereka it is 59,000. So you're supposed to compute 10% of the capital balance for the partners. So you get this and this because that's the percentage they gave us for interest. You'll be getting this. Still, you're supposed to be less in it. The total of this is this one. Then you're supposed to less salary, the salaries, if any partner is having some salary to be paid. So you check, when you check our income statement, they said that there's some salary that was relating to Bwambale which wasn't paid. So it means you're supposed to still be less in that. They give us the figure. When you less it, when you add to this figure, when you add the interest on drawings and you less the two things, interest on capital and the salaries, you are going to be getting this figure. Now this figure is what we call profits to be shared, and we are sharing them. This is how we are sharing it. Of course, at the beginning of the question, they said the profits and losses are shared equally. So the ratio is 1 to 1. The ratio is 1 to 1. So it means, of course, if you are to get the profits that Bwambale got, to be 1 out of the total ratio times what the profit itself, 32,840. Then also it will be the same because they are sharing profits and losses equally. So it is these two figures. This is the way they are sharing this profit because it is the profit to be shared. So now we are supposed to post all these entries of the appropriation account into the capital account of partners. So I'm going to rub off so that I can get space to prepare the capital accounts, the current account of partners which was requested. Continuation of the number we are doing. So we ended with the contents of the appropriation account. Now we are posting them to the current account of partners because it is what they requested. So the opening balance, of course, when we check for the current account, they gave us the opening balance of Bwambale as this. So you recognize opening balance for capital. Of course, capital, its opening balance has to be this side. Current accounts, we are maintaining capital accounts, but in the current account. Then interest on capital, we saw it in the appropriation account. For Bwambale, it was this, and for Masereka, it was 5,900. When you go to partner salaries, it was only Bwambale entitled to salary. That's why you are seeing that it is only in the column of Bwambale where we recognize that salary being an increase in his capital balance. Then share of profits, of course they are sharing profits equally, that's why you're having equal figures here. When you go to this side, I told you drawing it is the only content whereby it is not in the appropriation account, but you're supposed to include it in the current account of partners or in the accounts of partners. So drawings, you check when you check the question they were given. For Wambale it is 12,800 and for Maseruka it is 11,300. Interest on drawings, of course, still reduces the balances of partners. When you they gave these figures to us, 360 for Wambale and Maseruka, that one. Then the closing balances are these ones. Of course, when you balance, this side is bigger, so you have these two as your closing balances. And they are the ones that are supposed to take to the balance sheet in relation to the current account. The capital account balances were given, so it means, of course, you'll be balancing it, they will remain the same balances, which will be taken in relation to the capital account. But this is the current account. So for the balance sheet of the partners, of course, you are going to see that the only thing that is supposed to change is the normal balance sheet. But when in the balance sheet for partners, when you reach the equity component of the balance sheet, equity, you are supposed to be recognizing. We don't recognize all things of drawings or net profit, but here we only recognize the balances of the capital account, which were given for Maseruka, Wambale, and Maseruka respectively. So you have those balances in the trial balance. Then for the current account, we have gotten new balances. Current account for Wambale and Maseruka respectively, we have gotten new balances. Those closing balances are what we record in our balance sheet. But other things are the same contents of the balance sheet.